if you're an Upstart stock investor or someone that's interested in Upstart stock, here are a few things that you should know about the company. And it relates to the progress in its longer term business model, where it wants to be a platform that brings together borrowers and lenders. That's the ultimate aim of the business. It doesn't want to be the person, or it doesn't want to be the firm that's funding the loans. It wants other investors to put up the money, but it just wants to be the platform. So there's some important developments here I'll share with you in this brief video. Let's get into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the management team said that they continue to see strong loan performance with 1-day delinquent to charge-off rates down 13%. And even more compelling is that 30-day delinquency rates have trended down through the third quarter. And this is the question mark investors and lenders on the platform want to have answered is, longer term, what are going to be the company's delinquency rates on the loans that it originates, right? Because it uses a different model to evaluate borrowers. It doesn't use the traditional model that banks use to evaluate borrowers. It uses an artificial intelligence model, and it frequently updates that model. So if that model that Upstart uses is as effective as the traditional model or even better than the traditional model, then it's going to attract more lenders to the platform because lenders are going to receive benefits as a result. That means lenders are going to get, for the same borrower quality, they're going to get higher payment rates, or they're going to get a higher interest rate, overall better performance on the loans that they're making because Upstart is better at selecting borrowers and determining what interest rates each borrower should pay based on their risk analysis using the AI model. So that's the big question mark for the business longer term. And so far, so good. So far, so good for Upstart. Now, another thing that investors need to know is that lenders are now coming back to the market. A few weeks earlier, I would say maybe 4 weeks ago, 6 weeks ago, they announced a partnership with Blue Owl, whereby that company will purchase up to $2 billion in loans from the Upstart platform over the next 18 months. That means that they will be funding those loans, right? That's the big thing that Upstart wants is lenders like Blue Owl that provide the capital to make the loans on the platform. I've said this, repeatedly now, but there's never a shortage of borrowers. The constraint for Upstart is finding lenders for the platform and the lenders putting up money on the platform because borrowers will always be there. Borrowers are always looking for money to borrow. Our entire world economy operates on borrowing. And so that part of it, it's fine. The company doesn't have difficulty there. No shortage of people coming to the website looking for loans. And it's good news that they're now getting funding from lenders that are saying, we are interested in making loans now. We're not afraid of a recession anymore. We want to make loans. And in the third quarter, well over half of their loan funding was in the form of longer-term committed partnerships. And that's what they need. They need more of this longer-term committed partnerships. What would be great for Upstart's business is to have so much funding that it's too much. And that would be a good problem to have, where that side of the equation is overwhelming the platform. And then Upstart can focus on increasing marketing efforts to attract more borrowers to its platform instead of borrowers going to traditional banks or elsewhere looking for loans. Now, that's a long ways away, in my opinion. Upstart still has a constraint with not enough funding on the platform. And so this is a good step forward, and hopefully there will be more like this in the future. Banks and credit unions are increasing the funding on the Upstart platform. As banks and credit unions get more money and they want to make more loans, they look at the Upstart platform as an interesting place to deploy capital. And that's all helping Upstart's balance sheet. The volume of loans on Upstart's balance sheet continues to trend down, even while originations have accelerated. And this is the key, right? In the beginning, I highlighted the business model for Upstart. They want to be a platform that brings together borrowers and lenders. They don't want to be the one making the loans. But in recent quarters, they have been making loans. And it's because there's a shortage of funding on the platform. So when there's a shortage of funding on the platform, Upstart, rather than just rejecting every single borrower, chooses certain borrowers that they feel like it's going to be a good return on investment, and they go ahead and they fund those loans themselves with their own balance sheet. Now, they don't want to be doing that, but lately they have been doing that because of that constraint, because there isn't enough funding on the platform. Eventually, if the funding on the platform increases from banks and other partners, then Upstart can completely step back and be a true platform business model where they just bring together borrowers and lenders. And then occasionally, opportunistically, they can step in, like in this current macroeconomic environment when lenders pulled back, they can step in and make the loans. But as an investor, you don't want to see that. You don't want the company to turn into the company that has to fund the loans on the platform, because that's a whole nother business model. That's a riskier business model that will lead to lower profit margins, lower cash flow from operations, lower returns on invested capital. It's much more lucrative for Upstart to just operate the platform and invest its money in improving the platform, improving the AI model, improving the processes that will generate better returns on investment than if Upstart is making loans, right? Because making loans, um, there's a certain percentage rate that you get when you're making a loan, but you're also taking the risk when you're making a loan, especially personal loans, which is the area where Upstart's primary business is right now. They're trying to branch out, but it's mostly personal loans. And those have zero collateral. And so you're going to get a higher interest rate, but you're also going to have higher default rates. And so it's not a very lucrative business. And Upstart understands that, and they're not trying to do that, but they had to do that out of necessity. And the recent developments over the last quarter are positive in its ability to step away from making the loans itself and returning to its more lucrative forms of generating revenue and business. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.